this last pullback. We'll talk about last week's pullback in a moment and some of the things that I found interesting about it. But I mean, look, first and foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there's a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled.
The latest gold and silver price drop has confused market analysts. After 9 weeks of steady rises and building investor euphoria, both metals' rapid and concentrated sell-off appeared to defy rising physical demand and fading fiat credibility. Profit-taking and overbought market circumstances were blamed by mainstream analysts. However, the timing and pattern of the sell-off during low liquidity trading windows reflect planning. Andy Schectman said this was a tactical maneuver to influence sentiment and accumulation. Instead of weakness, this planned pullback may show how institutional money behaves when it matters most. Major financial actors can temporarily depress market exuberance, induce algorithmic selling, and quietly accumulate actual metal at a discount by aggressively driving down paper prices in thin markets. It's a tried-and-true strategy to shake off retail holders and reload at better levels. They reinforce a bullish long-term trend of actual wealth transfer from paper to tangible assets. The lesson is obvious for experienced investors. Price variations in precious metals are no longer dependable indicators of worth. Their purpose is strategic. Each dip is greeted with substantial physical deliveries, especially in silver, whose October distribution nearly tripled predictions. The paper physical market gap is widening by the month, suggesting genuine demand is being hidden. The hands-on delivery matters more than transient weakening charts. This retreat may be one of the most critical indications. When huge commercial banks, generally gold skeptics, advocate high allocations and purchase massively amid price drops, questions arise regarding what they perceive coming. Gold and silver markets may be communicating the same message central banks have followed for years. Get while you can. In his recent interview, Andy Schectman explained that the tale goes beyond short-term price movement. He discusses U.S. fiscal policy instability, rising debt, and institutional knowledge that paper assets are becoming riskier. His opinion links deliberate price suppression, the worldwide shift toward hard assets, and the stealthy preparation for monetary trust reordering. Please like this video, subscribe for more data-driven market analysis, and stay tuned as Andy explains the true reasons behind this latest price drop and why it could be one of the largest metals market chances yet. Please enjoy the video and thanks for supporting us.
Here we are on Monday, and I won't know until tomorrow or later tonight what has precipitated this last pullback. We'll talk about last week's pullback in a moment and some of the things that I found interesting about it. But I mean, look, first and foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there's a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged in individuals and groups realize that it is indeed the Achilles heel of the entire system, and they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like Nvidia and Apple that have defied gravity. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is a something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery and an immediate contract in October. So what was interesting to me about it as well was some of I think it's Michael Lynch, I think is his name, I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Thursday and Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly traded illiquid market. Period. No one would ever do that. They did. And it's done for effect. Specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night, or, after New York trading. That would change the outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity, to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1, and gold about halfway up. Because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional, and if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has the big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately.
Andy's analysis underscores an essential point that is seldom addressed by mainstream commentators: the distinction between physical ownership and paper transactions. He emphasizes that leveraged contracts dominate the gold and silver markets, and they can be manipulated through large, concentrated orders during periods of low trading volume. This enables major players to momentarily manipulate prices while simultaneously establishing a favorable position in the delivery cycle. The recent increase in October deliveries, in conjunction with a record-breaking physical offtake, serves as evidence that the demand for actual bullion has increased, despite the decline in paper prices. This is the tranquil dissolution of a rehypothecated system, a structure that was constructed on the assurances of metal that far surpass the capabilities of vaults, as Schectman describes it. The correlation between these patterns and a deteriorating macroeconomic backdrop is not a mere coincidence. U.S. fiscal policy has entered uncharted territory, as deficits are increasing at a rate that even experienced analysts find alarming. A fiscal trajectory that is mathematically unsustainable is exemplified by the government's addition of $1 trillion in new debt within a mere 71 days. This type of imbalance, in which debt servicing now rivals or surpasses core budget items, is precisely the environment in which tangible finite assets regain their monetary relevance. The global financial elite comprehend this dynamic, as Andy observes, and their actions in the physical metals market are indicative of preparation rather than speculation.
Gosh. And to your point of fiscal irresponsibility, the U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York, or the shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where at the same time you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're treasurers and you see the fiscal irresponsibility mounting, at some point, this debt does become a problem. And the people who point to it not being a problem, I think, are missing the picture.
The United States, which has historically relied on the dollar's reserve status to mitigate fiscal excess, is currently experiencing the repercussions of this privilege. Foreign governments and sovereign funds are discreetly constructing parallel trade systems that increasingly bypass the dollar. As the debt-to-GDP ratio approaches 130% and confidence in treasury markets is eroding, the Shanghai Gold Exchange and China's cross-border interbank payment system are key mechanisms that facilitate the direct conversion of yuan balances into physical gold. This transition is fundamentally driven by the resurgence of gold as a settlement medium. This linkage effectively converts the yuan into a quasi-gold-backed currency, at least in terms of function, if not in name. These advancements are not purely theoretical. They are altering the structure of global trade in real time. The demand for physical bullion is expected to increase exponentially as more countries choose to settle in currencies other than the dollar, and as these currencies become more convertible into gold. In the interim, Western financial institutions, many of which previously regarded gold as a barbarous relic, are discreetly modifying their asset allocations. The message has transitioned from skepticism to strategic accumulation, with some analysts now advocating for a 25% exposure to gold, ranging from Morgan Stanley to Bank of America. This signifies a significant reevaluation of gold's function as a fundamental monetary asset, rather than as a hedge. Similar undercurrents are exacerbated by the dual industrial and monetary demand of the silver market. With record physical deliveries out of the COMEX and large-scale short positions on ETFs like SLV, silver's paper market appears to be becoming increasingly disconnected from its real-world fundamentals. The recognition of silver's true value may be delayed by the suppression of prices through naked shorting, but it cannot modify the underlying scarcity. It is probable that the revaluation will be abrupt, chaotic, and irreversible when it occurs. The more profound reality is that these movements are not arbitrary market vagaries, but rather the initial phases of systemic adjustment. Capital naturally pursues forms that are self-custodied, finite, and globally recognized as confidence in fiat instruments diminishes. Private investors will eventually experience the same behavior that sovereign funds and central banks are currently demonstrating. For those who comprehend that the window of strategic entry is missed by waiting for the official narrative to catch up, unmistakable signals are evident to those who are attentive. World positioning is underway. The decrease in prices is not indicative of failure, but rather of an opportunity, the final window before a generational repricing of real assets. The public is being kept distracted by the noise of short-term volatility, while the smart money is moving silently and methodically. I appreciate your attention. If you found this analysis to be beneficial, please consider liking, sharing, and subscribing. Stay tuned for additional in-depth discussions regarding the changing global financial landscape, gold, and silver. And it is important to remember that in a society that is based on promises, those who possess something genuine